Let's break down investor morale. It's a term you might hear on the news or read in financial reports, but what does it really mean for you, your community, or even the broader economy? Understanding this concept can give you a clearer picture of how the financial world ticks. Investor morale is simply the collective mood or attitude of people who are putting their money into a country's economy. Are investors feeling confident and ready to invest, or are they nervous and pulling back? This mood can shift quickly, influenced by everything from political events to economic data, and even global news. That's what we call investor morale. But why should you care about how investors are feeling? The answer is simple. Their mood can have a ripple effect that touches everyone, not just those on the trading floor. When investors are optimistic, they're more likely to put money into businesses, which helps those companies grow, create new jobs, and boost the overall economy. On the flip side, when investors are fearful or uncertain, they might hold back, leading to slower growth, fewer job opportunities, and sometimes even economic downturns. To keep track of this ever-changing mood, we use tools like Germany's ZEW Economic Sentiment Index. This survey asks financial experts for their outlook on the economy over the next 6 months, capturing their hopes, worries, and expectations. A positive score on the index means there's more optimism among experts, while a negative score signals growing pessimism. These numbers can shift with every new headline or policy change. Think of this index as a thermometer for the financial world, a quick way to check the temperature of those steering the economic ship. When you understand investor morale, you can better see how global events and news stories might impact your own finances, investments, or even your job. It's not about predicting the future with perfect accuracy. It's about being informed and prepared. When you realize that economic news is really about people's collective feelings and actions, it becomes less intimidating and much more relatable. Knowledge is power. By understanding investor morale, you can make smarter, more confident decisions with your money, instead of reacting out of fear or uncertainty. It's about taking control of your financial future. That's what we're here for, to help you feel powerful, not powerless, as you navigate the world of finance and investment. Let's talk about the latest ZEW report. Experts predicted investor morale in Germany would rise in February 2026, expecting the index to hit 65.0. Instead, it dropped from 59.6 in January to 58.3 in February. This unexpected decline caught everyone off guard. When forecasts miss, it shakes confidence and raises questions. Why are experts less optimistic now? The drop signals underlying worries, even as some recent data looked positive. It's a yellow flag. Recovery may not be as smooth as hoped. But remember, 1 month's data isn't a trend. Still, it's a sign that growing confidence has hit a snag. For Germany, Europe's economic engine, this matters to everyone: policymakers, business leaders, and you. It's a reminder, economic recoveries are rarely straight lines. Stay alert, not alarmed. Let's dig deeper into what's really happening. Here's where it gets interesting. The ZEW report gives us 2 numbers, and together, they paint a complex picture of Germany's economic mood. The first is the expectations index, which actually fell this month. This drop signals that financial experts are feeling less optimistic about what's coming next. They're worried about potential challenges on the horizon, maybe global uncertainty, inflation, or shifting demand. But then there's the current situation index, which tells a different story. It improved, rising from 72.7 to 65.9, a noticeable jump. While it's still in negative territory, this upward movement suggests that conditions on the ground are getting better right now. Shops are seeing more customers, factories are ramping up production, and there's a sense of cautious optimism in the air. This means that, at least for the moment, the German economy is showing signs of healing, even if the future remains cloudy. It's a mixed message. Present conditions are improving, but experts are still wary about what's ahead. Think of it like feeling healthier today, but your doctor reminds you to keep an eye on your long-term health. The recovery is real, but it's also fragile, and setbacks are still possible. This split, better now, worries for later, shows just how delicate the situation is. The economy is healing, but it's not out of the woods yet, and every positive sign comes with a note of caution. The improvement is real, but so are the risks. Businesses and investors are moving forward, but they're keeping a close watch on warning signs. Navigating this environment means balancing hope with caution and making smart decisions in uncertain times. So, which industries are leading the way in this recovery, and which ones are still struggling to find their footing? Let's take a closer look at where Germany's real strengths and weaknesses lie as the story unfolds. Germany's economy isn't all good or all bad, it's a mix. Some key sectors are showing real recovery, even as overall outlook dips. Chemical and pharmaceutical industries, steel and metal production, and mechanical engineering are all seeing brighter prospects. Why? Strong new orders at the end of 2025 gave these sectors confidence. Busy factories mean more jobs and stability. When these industrial giants do well, the whole economy benefits. Their strength helps offset broader investor caution. It's a sign of resilience at the core of Germany's economy. Two more bright spots: private consumption and exports. Consumer spending is picking up. People feel more secure, so they're buying more. This boosts businesses of all sizes. At the same time, exports are strong, with global demand for German goods rising. More exports mean more jobs and profits, fueling a positive cycle. These forces, spending at home and sales abroad, are keeping the economy steady. Even with future worries, today's real activity is solid. These aren't just numbers, they're signs of real momentum. You might wonder, how does German investor morale affect me? It's a fair question. After all, most of us don't spend our days watching the stock market or reading financial reports. But the truth is, the mood of investors in Germany can have a surprising impact on your daily routine, even if you live far away. Low investor confidence can ripple out. Companies delay projects, jobs are put on hold, and suppliers feel the pinch. When businesses sense uncertainty, they often tighten their budgets, which can mean fewer opportunities and less spending across the board. This caution can reach your own workplace, affecting job security and income. Even if you're not in finance, your company might depend on German clients or suppliers, so a slowdown there can mean changes for you here. Investor sentiment also impacts interest rates and currency values. When confidence drops, central banks may adjust rates to stabilize the economy, which can affect your savings and loans. If investors pull out of Europe, the dollar strengthens, making imports pricier for you. Everyday goods, like electronics, clothes, or even groceries, can suddenly cost more, stretching your budget. Economic uncertainty can change borrowing costs, affecting your mortgage, car loan, and credit cards. Lenders may raise interest rates or tighten requirements, making it harder or more expensive to borrow money. Your retirement accounts are tied to global companies. If Europe slows, so can their profits, and your investments may take a hit. Even a small dip in European markets can ripple through your 401k or pension plan. The global economy is interconnected. German companies trade with partners worldwide, so their ups and downs can influence jobs, prices, and growth everywhere. What happens in Germany can impact your wallet, even from thousands of miles away. The effects might be subtle at first, but over time, they can add up in ways you notice. Understanding these links helps you make smarter choices. By staying informed, you can better plan for changes in prices, interest rates, or job prospects. It's all one big system. Your financial life is part of it. Stay aware, not anxious. Knowledge is power, and being prepared helps you navigate uncertainty. Let's look at the bigger picture for Europe and the world, and see how these connections shape our everyday lives. Germany is Europe's economic anchor. When it stumbles, the whole continent feels it. Many European countries supply parts to German industries. If Germany slows, so do they. German consumers buy goods from across Europe. If they cut back, it hurts neighbors. German banks lend across the EU, Caution at home means tighter credit abroad. Globally, Germany is a top exporter. Its slowdown affects demand for raw materials and tech worldwide. That's why a dip in German morale is watched from Tokyo to Toronto. Germany's recovery is a barometer for the global economy. When Europe's engine sputters, the world slows down. When you see headlines about economic uncertainty, don't panic. The worst financial decisions come from fear. Stick to your long-term plan. Don't react to every headline. Use this moment to review your finances. Do you have an emergency fund? If not, make building one your top priority. Pay down high-interest debt. It's a risk in tough times. Focus on what you can control, not what investors in Germany are doing. Keep investing regularly for the long term. Ignore short-term market swings. Dollar cost averaging helps smooth out the bumps. Don't try to time the market. Just stay consistent. Financial strength comes from discipline, not drama. Stay calm, stay focused, and keep building your security. That's how you thrive, no matter what the headlines say. Your greatest asset is your financial intelligence. Don't just follow advice. Understand why it works. Learn the basics: budgeting, debt, saving, and investing. Knowledge builds confidence, and confidence beats fear. Money is a tool. Learn to use it well. Educate yourself. It's the best investment you'll ever make. Every step you take to learn more puts you in control. Stay curious, stay strong, and keep building your financial future.